Hello, this is Dale. We've had a very profitable earnings season. If you remember, what I did was a pretty rigorous study going back 4 years, looking at these 6 stocks: Google, Amazon, Chipotle Mexican Grill, Netflix, Tesla, and Apple, to see if I could find a repeatable way of trading during earnings, when usually you have a move, if not a very big move, during that period. I looked at strangles and straddles, and unfortunately they do not work because the premiums are so high, because volatility, as you get closer and closer to earnings, the volatility increases, increasing the premiums. So you have to have almost an explosion of prices for you to be profitable using straddles and strangles. One of the things that I love to teach are bear calls and bull puts, or credit spreads. And what I did is I put them two together, the bear call and the bull put, and that's what is called an Iron Condor. But what I wanted to do, and what you're trying to do is try to see if the price stays within the boundaries of the lower price of the bull put and the upper price of the bear call. However, you don't want to go too far out, because the credit that you'll get makes it a little bit more risky. It's a risk-reward setup. So my rigorous study, what I did is I went back and looked at all these 6 stocks and came up with an average move. And then I went and looked at the range of the moves and determined that for Google, 11 out of the 16 times, or 69%, it stayed within plus or minus 5%. I did that for all the rest. Amazon was 6%. Chipotle was a little bit higher, 7.4%. And these stayed within there 75% of the time. That's a great statistic to know, and you can profit using that. Netflix, 8%. Tesla, a little bit high. That's the highest one, 9.1%. And then Apple was 6%. These are the profits during this last earnings season that just ended the last day of April. Google was up $1,300, and this was for 10 contracts in Google. Amazon was quite a bit higher at 4,000. Chipotle was 1,000. Netflix really banged it out of the park. I was able to take this all the way to expiration and got 5,670. Tesla 3,800, and then Apple 1,600. These are all based on 10 contracts of Iron Condors, and the margin required on those is $10,000 minus the credit that you bring in. So usually it's about right around $5,000 to $6,000 margin requirement, and you can see the kind of returns you're getting on that kind of investment. It really looks very nice. Now, the key to this is you want to set up an Iron Condor. You don't want it to be too far away, because then you're not going to get the kind of credit you're looking for. But using historical data, you can kind of bring that in a little bit and make it a little bit tighter Iron Condor, and this is the kind of profits that you can get. The rules are pretty simple. I only trade these 6 higher price stocks, and once again, the reason is you get good credit, and also you have good open interest, so you've got good liquidity in those stocks. What I do is I set up an Iron Condor about 2 days before earnings, and what that is to sell an out of the money bull put, sell at the price equal to or the average move, and buy 10 strike prices further out of the money. And then for the bear call, I want to sell at a price equal to the average move and buy 10 strike prices further out of the money. You always want to buy the number of contracts based on your trade size, based on your portfolio. You never want to overtrade. That is the number one reason why retail investors lose in the stock market. They overtrade their account. Now, the rules to exit is if earnings has an average move that's greater than, I exit immediately. If earnings has less than the average move, I'll consider staying until expiration. And so basically you are trading those last 2 days before it does expire. And once again, the credit for the trade is the combination of the bull put and the bear call, and you'll see that in the next slide. This is how I set up Chipolte. Chipotle's earnings was after hours on Tuesday, April 21st. So on Monday, about noontime, the day before earnings, and I set this up, and the current price was $8.12. You take 7.5% of 8.12 and subtract it from the 8.14, and you get 7.55. You add it to the 8.14, and you get 8.80. Those are the two strikes that I sell. You can see you sell on the 8.80, selling the 7.55 put. Okay, and you're bringing in a nice amount of credit. Okay, so basically we're selling, and I'm going very close to when earnings happen, selling the 24 April, the 7.55, and then buying the 7.45 for protection out of the money. And then for the bear call, I'm selling the 8.80 and buying one further out of the money, 8.90 for protection. Now, what happened is the morning after earnings, Chipotle opened at 8.48. Okay, 8.48 is below the 8.80 strike. So what I did is I watched this for a while, and I went ahead and exited that with a debit of $4.23 or a profit of $1.10, or $110 per contract, or $1,100 for 10 contracts. Okay, and this is the process that I did for every one. And you can see for Netflix, what I did was sold an Iron Condor, again, the 24 April at 400, and then bought one at 390, sold one at 470 and bought one at 480. That was 8% of the current price that it was at. The morning after earnings, Netflix opened at 429, which was well within the limits. I let this go to expiration and collected the full credit that I brought in, which was a profit of $567 per contract, $5,670 for 10. Google, what I did is I sold a 1 May, because you can see it had earnings after hours on Tuesday, the 28th. So the closest I could get was the 1 May. And you can see that what I did is the current price was at $12.85, and I subtracted 5.5% and added 5.5% to give me the ones that I sold was the $12.15, bought the $12.05, sold the $13.60, bought the $13.70, brought in $4.05 credit. The morning after earnings, Google opened at 345, which was within the limits, but it was close. Now, Google closed at the end of the day at a debit of $2.68. During the day, Google dropped back well within the range. However, I decided to close it at the end of the day, took a profit of $1.37 or 137 or $13.70 for 10. Then on Tesla, current price was $7.68. 9% of that means I want to sell the bull put at 700, sell the bear call at 840. The morning after earnings, Tesla opened at 855. 855 was above this range. However, in watching the early trading, 1 hour later, Tesla had already dropped to 827, which was within the range. It continued to drop, and I decided to exit at the close for an 87-cent debit. That was a profit of $3.82, 380 per contract, 3,820 for 10. Amazon was at the 23.40, 6% of that. Subtracting that was 2,200, adding it was 24.80. Here's the Iron Condor that I set up for $4.05. The morning after earnings, Amazon opened way low after a previous day high. See, what happened is before earnings, the day before earnings, Amazon had gone way up in expectation of that. And then it actually missed its projection, and it dropped way down, but that was well within the limits that we had set up. I let it go to expiration and collected the total amount. $405 per contract, $4,050 for 10. And then the last one was Apple. Apple was relatively cheap. It's the cheapest one of all. Sold for $286. 6% of that was we're selling the bull put at 270, selling the bear call at 300. The morning after earnings, Apple opened at 298 within the limits, but it quickly dropped. Here again, we let it go to expiration and collected the total amount. Now, one of the things about Apple is I'm probably not going to do Apple anymore because it's a lower price stock. And the kind of credit that I'm receiving was not as great as the ones that I receive on an Amazon and a Google. So there's more risk involved with Apple. So if I go back and I look at my list, I think as I go further, I'm going to concentrate on the very big boys, and that is Google, Amazon, which are the biggest ones. The next group would probably be Chipotle, Mexican Grill, Netflix, and Tesla, and probably dropping Apple off the list. You say, well, that's only 5 trades during earnings season. But if you can profit every earnings season after earnings season, this can be quite a profitable and successful strategy for you to use. I hope you enjoyed this video. Bye-bye now.